Hi, Dominique, and welcome again to another week of the week ahead. And excited as always. And once again, an incredibly exciting and volatile week, not just us internally in MacFi, but like a lot of clients have been pointing out this past week that the Fed and the market as a whole is getting closer and closer to your 8% call. And I saw one of the clients even saying you should get a Nobel Prize
Well,
for a
maybe
call.
exaggerated.
Yes, but it was cool, and it's great to see that clients really appreciating it, and also the fact that you continue to back it up with facts and data, and showing what the progression and why they can't kind of really pause at this point, where obviously different times in last 3 or 4 months, the market had anticipated things like that. So maybe to kick off, let's start and get your take on actions from the past week, market interpretations, data, everything.
So let's start with the Fed. I think Chair Powell is definitely getting better at pushing the market in the direction he wants. I was correct that he was nowhere near ending the rate hikes, but I underestimated him because I expected that, if he announced a pivot to a slower pace of hike, financial conditions would ease. And actually, no, in fact, financial conditions got tightened. So the market didn't like the treatment of the statement saying, going too slow, and then the price conference being extremely hawkish, but that did the trick. I mean, he managed to get the market to pricing slower hikes, and yet it wasn't good overall for risk assets. So it's one for Chair Powell, I think.
Yeah, yeah. Any other data? I guess payroll data and stuff today, and anything else during the week?
Well, the payroll data was really, as I expected, higher. I couldn't understand the pessimism of the street, but as you know, I don't pay too much attention to consensus views. I focus more on the data, on what the markets are telling me and clients, especially. And so, yeah, I expected a surprise. The next, we'll talk about the coming week, but what I'm also looking at is a possible pickup in growth in the fourth quarter because fiscal consolidation is behind us. In fact, this week there were some rumors that the Democrats could use what is called the lame duck session of Congress, which is basically the session after the midterms election that are in a week, and up to the end of the current Congress. So November, December. So there was some talk that they could use it to raise the debt ceiling through reconciliation. So basically raise the debt ceiling while they still have a majority in both chambers. And if they do that, the Republicans are not going to be happy, obviously, because it will remove their main leverage. So if that happens, it means we could have actually fiscal easing at least, until, well, I mean, you could have, if the debt ceiling is raised before the end of the year, what's going to happen is that, of course, the Republicans will cry murder, but you will have a series of continuing resolutions throughout the year because there won't be any agreement on fiscal policy. But at the same time, neither side will want to be responsible for shutting down the government. So that again would be very bullish for growth. And then, there is these things I've been talking about for a long time, which is the savings rate, the household savings rates falling and still very low. So this is not a rebound in growth, is not my base case scenario. There is not enough data for that, but I'm on the lookout for signs that this is really happening.
What was the point unemployment? The unemployment data looked like it was all pretty strong. Wages were higher, but the market, I mean, if I'm looking at even like 2-year, 5-year yields are slightly lower. obviously there's been a steepening in the curve. Is it because, well, you can talk about it, this, I guess, two different surveys, but was there anything else? And I forgot, isn't there an employment, sorry, like there's another inflation data point that comes out on the same day as payrolls, or am I imagining that?
Well, the wage data, which was up a little bit, but basically, what you had today was the payroll survey showing employment up 260K, and the household survey showing employment down 330K. And I've just published a review which
Yes.
shows, yeah, the payroll is a much higher quality. Also, if you look at just about every other labor market indicator, most timely, most high frequency is jobless claim, continuing claims are stable. We've had an increase in job openings, even within the NFP, wages accelerated, participation fell, hours worked remain constant. So every other data tells you that once more, the household survey is generating noise. And that's why we've had a 20 basis point increase in unemployment. But, in terms of a gap between household and payroll survey, we are like at a peak. We had actually, interestingly, the previous peak was exactly a year ago. So I don't know if there is some weird data going on in the background.
Right.
But the gap between the two is going to narrow next month, and we will probably see a revision of the unemployment rate lower.
Lower. If I look at this average hourly earnings, so it came in at 4.7% annual rate, I guess. I mean, it has been trending down a bit, even though I guess it came in line with what was expected. Is that also a reason why that maybe the bond market's more neutral, or?
Sure, but I think it's a misplaced reason because that data is biased by compositional effects. If you look at unbiased data, such as employment cost index or the Atlanta Fed median wage, those have started to move sideways, but remain in a 7%. And Chair Powell was mentioning it in his press conference. These are much higher than consistent with a 2% inflation.
Okay. Anything else that stood out last week? Market reaction or anything? So,
well, I mean, the market in a way is going through the 5 stages of grief. When something happens which is unacceptable, I think you go through anger, denial, or there is a Swiss psychologist who wrote books about basically what we are going through is one, the Fed put is gone, and two, the economy is definancializing, which is going to be even more painful. And, we've had, 20 years of Fed put? More than that? I'm not sure.
what do you mean about the economy becoming definancializing?
I think the ratio of financial assets to GDP, of the value of financial assets to GDP, is falling. And I don't think it's going to recover because we are moving to a structurally higher inflation regime, which will force central banks to remain tighter, and so where real interest rates will be higher, and that's negative for asset values, leverage, all the nice things that meant that for 20 years, all we had to do was to be long risk and just, see the dollars rolling in, and those days are over. And, it's a source of grief for the market. And I have to research these 5 stages of grief. I should know that.
I know you. I feel like you reference it. I can imagine in my head or seeing it, but yeah, I don't remember all the different 5 stages. I just remember that there was a chart kind of showing it.
Yeah, so we're still working our way through those, I think.
Yeah.
I mean, I don't want to be too smug. I mean, as you said, data, and data. I need to remain very close to the data. I could be wrong, and I remain absolutely open to the idea of being wrong. In fact, several clients have asked me, what would it take for you to change your mind? And so I'm very mindful that things change. Things could change.
Yeah, I think people, without speaking to you or reading a lot of your research, just hear the 8% call and just think, oh, you just picked that out of thin air. But this is something you've been working on all year, and you constantly update it and update your analysis. And as we've discussed in a lot of our calls, the data has just been reinforcing that call. It's not a question of, fitting this view around just price action and stuff. This is something different. Yeah, which is, you've had an amazing call. I'm not sure about the Nobel Prize, but I did see that.
The year is not over. We still have we are early November, so we have 6 weeks, 7 weeks. Yeah. And these are going to be quite, the year is going to end with the mid-December FOMC, basically. So we have a few bumpy weeks ahead of us still.
Yeah, I agree. Okay, awesome. And then for the week ahead, what are you thinking? Obviously there's a lot of stuff this past week between data and FOMC. So what should people be looking? What are you looking out for?
So let's talk about the CPI and the elections. So the CPI first, the consensus is for 50 basis point month on month for core, which is enormous. And so I don't disagree with. As always, I will be looking for the usual trend up in trim mean and median price CPI. I will be looking for a trend up in services CPI and continued stable goods price inflation. So again, it's not just the headline number, but the underlying trends.
Yeah, and as you say, 0.5% for core just in itself is going to be a big it's a big one. Okay, outside of CPI, what else? Anything else that?
So it looks more and more like the Republicans are going to capture the Senate and the House. And so we're going to have policy paralysis. In terms of fiscal policy, if the debt ceiling is not raised during the lame duck session, we're going to have, the usual theatrics and chest thumping by the various alpha persons on each side and so on and so forth, but some agreements and more fiscal consolidation than we would have if the Democrats raise the debt ceiling while they have the majority. But even if we go through the theatrics of a debt ceiling fight, it's not going to get settled until mid-year. So between now and mid-year, we're going to have some form of fiscal easing, which will also be very supportive of growth. Other than that, I can't think of significant policy changes. The one thing where there is bipartisan agreement is economic nationalism and China bashing. So we could get a bit more of that. But outside of this topic, I really see policy paralysis because neither party will have the filibuster-proof majority that would be needed to get laws through the Senate.
Yeah.
So that's about it. But so the most likely outcome as of today is that.
It doesn't sound terrible. Tax, I can speak versus the UK. Taxes are fairly low. US is fairly business friendly. The Democrats were, for people, the focus on climate change, they were able to pass a lot of incentives for green energy, infrastructure, batteries, solar. So it's kind of like, if they don't pass a lot of stuff, maybe it's not that terrible a thing, as opposed to in the UK where they're talking about raising taxes and all this stuff.
Yeah,
I think a different fiscal situation, but
the irony is that the US has more latitude to do fiscal expansion because it holds the world currency.
Yeah.
But the policy paralysis in the US is much greater than in the UK. In fact, it's quite the opposite. It's almost impossible given how the US is made up for one party to get a filibuster-proof majority in the Senate.
Yes.
So nothing happens. While in the UK, it's the opposite. Once one party gets elected, it is in power for 5 years, no matter what, and it can change its prime minister as often as it wishes to. So the check and balances, the political check and balances are much stronger in the US than in the UK. But the market check and balances are much stronger in the UK than in the US.
Yes. I guess two other questions, and then I'll let you go. Is if China does, there's a lot of talk today, and there's a press conference I think tomorrow, and obviously Bert is really the kind of China expert, but China does announce a loosening of the zero COVID policy. Would any of that impact your views in any way?
Oh, poor Mr. Powell. He must be praying that this doesn't happen. Well, I mean, if China goes for let's go, which, by the way, Bert has been very consistent on this. He thinks that they will stick to the zero COVID policy until the spring, because if they reopen just ahead of winter, the consequences could be quite dire.
Yeah, 100%. 100%. Yeah.
But if China surprise, and so Bert thinks that there might be changes, but only at the margin. So if China surprises, then and does let go of the zero COVID, then the Fed is in real trouble, because you're going to have higher commodities prices, so higher headline inflation, which is going to feed into expectations. Personally, I don't think it makes a difference, but the Fed thinks it makes an enormous difference. But the other thing that's going to happen, which in my view is very much more important, is that when you have such a tight labor market, if you get a jump in energy and food prices, wage growth is going to accelerate. And so the increase in headline inflation is going to translate into an increase in core inflation. That
could be, it could be pretty bad.
For the Fed, yeah. And for all of us, by the way, because inflation is not benefiting anyone.
Okay. I mean, that was my main stuff. Okay, awesome. And as we've been doing the last couple of weeks, just a quick recap. I know we have a mix of different types of listeners. First, for our pro clients, again, as always, we loved all the interaction. This week in particular has probably been the most interaction that we've seen between our clients and all of us. And it's been, I think it's a good indication that we're really kind of connecting, and clients are reaching out to us, engaging to us in very kind of volatile times and with very important data going out and big market moves. So, to me, I always think of the most important thing is not just that we produce great content, but that we're really able to kind of deliver that and become part of our clients' workflow. And that's really the important thing. And this week, I really feel like it was really unique. Obviously, you being a very key part of that. So that's been awesome. I'll just quickly highlight a couple of pieces, even a lot of stuff that came out today. Bilal, again, he just keeps finding like super cool, very interesting topics. I love the piece last week from the Macroscope when looking at the difference in Apple's kind of comments around China and BASF, the German company. But this week is a big focus on the US dollar, as especially people on Twitter, but just in general, so many times people calling for the end of the dollar kind of dominance or the rise of renminbi, and he kind of breaks down. So super cool analysis. And I think for investors, it's really interesting. The other thing is, and I think we'll kind of do a webinar in the next couple of weeks for our pro clients, is Bilal and Dalvir have really been building out a lot of our model-based capabilities, and integrating a lot of machine learning in those models, including like trading signals. And the guys have put out a few pieces this week. I would definitely check out those, and also look out for this webinar we should be doing in the next kind of 1 to 2 weeks, hopefully. And then for our prime clients, and obviously free, recommend for you to sign up for Prime and get access to these. All our clients we love, and any way we can help clients be better educated about markets, make better investment decisions. That's what we're trying to do. But Bilal's piece today on asset allocation and how you should take into consideration Dominique's calls on higher rates. Part of your asset allocation thinking is very important. John Tierney wrote a full piece on NASDAQ. He said for weeks or calls we've always been on that, according to his models, that the NASDAQ still is a bit expensive. He now kind of views it as fair value, but he kind of talks through that set of thinking and where he thinks we're going to go from here. That would be a cool piece to check out. And then, as always, there was Davir did a cool piece on Bitcoin and is it bottoming, and looking at a bunch of different myriad of factors, including big collapse in volatility, in actual volatility, and what we think that may signal. So please check all those things out. Dominique, have an awesome weekend. I hear my son throwing things downstairs, so we need to get ready for dinner. And so I wish everyone a great weekend and good luck next week. And thank you, Dominique.
So good luck, everybody, on the market. And please, get back to us with as many questions as possible, and, criticism very gratefully received, because this is what keeps me on my toes, basically.